Analyst. Now let's talk about the world's third biggest retailer, Tesco. It looks set to announce the sale of much of its property in a bid to plug the hole in its finances. Valuable Asian real estate alone should raise hundreds of millions of dollars for the company. Tesco issued its fourth profits warning in 5 months last week, sparking another sharp fall in its share price. The British company has been in turmoil since it had to admit it overstated its profits. Its share price has plunged and several key managers have had to leave. Credit rating agencies have also warned they may downgrade Tesco's debt to junk status. Well, I'm joined by Chahal, an analyst with Fat Profits, to talk us through this process. Sarb, the business at home in the UK has been struggling for a long time. The international business in places like Thailand and South Korea have been doing rather well. So why are they flogging it off, do you think?
Well, I think what we've seen is Tesco had a very good focus on the international market, but we've seen in Japan and also coming out of the US, they've actually been scaling that back. And I think it's more of a case of what they're looking to do with this potential sale is actually refocus on the UK. That brings in 2/3 of their profit. So I think it's well documented how the discounters had basically started to eat into their profits. So it's really actually about saying, well, get rid of non-core assets, focus on the UK.
So in a sense, is Tesco kind of withdrawing from the global market? Because as you say, the fresh and easy idea in the US just didn't work at all. That was quite a separate scenario. But its businesses in Asia have been doing quite well and bringing in valuable revenues for Tesco, but just not enough for it to hang on to them.
Well, I think it's more of a case of that they have to do something now about the brand, you know, because looking longer term, is it the right thing to be selling off profitable parts of the business? I think only really time will tell there. But if we actually look at the figures, £692 million worth of profit came from Asia. Putting that into some sort of context, that's 1/5 of profit right across the group. So there's value there. Certainly there's value there. But I think it's more of a case that the brand has been weakened. We've seen BlackRock, second largest shareholder in Tesco. They've been dumping shares. We've seen Warren Buffett, famous investor there, he's held his hands up and said it was a huge mistake going into Tesco. So I think something needs to be done about the brand sooner rather than later. So
desperate measures at desperate times, but in the long term, do you think Tesco will want to try and go global again in a major way? Because clearly, you know, if it's going to remain as the world's #3 retailer, it needs to have a presence in other parts of the world.
Certainly. I think it's really a case for them now of saying, well, let's focus on the UK brand, let's actually get rid of the non-core assets and then reinvest that money back into the UK, because I think that what they've done and probably can be accused of here is taking their eye off their core market. So by actually this potential sale, they could then reinvest that money and basically, as the #1 retailer in the UK, throw a bit of their weight around.
All right, well, we'll watch with interest and we'll keep our viewers up to date. Thank you very much, Sarb, for coming in from Fat Profits.